Look, it's no secret. All right. The upside momentum to this market is still really strong. Okay. However, you could just, there's no green long term signals, right? If you look at anything, terms of valuation, in terms of aggregate allocation to equities, in terms of sentiment, they're all suggesting we could be in trouble ahead. So I went and I looked. There's a new paper out by a fellow named Tom Carlson. He's written some books and some other things. And he wrote Defense First, The Secret to Winning with Tactical Asset Allocation. This is a very cool strategy because it's one of the better risk on, risk off systems that you'll see. This simple system, Ryan, is really, really simple. We're going to take four widely traded ETFs. We're going to take TLT, we're going to take GLD, we're going to take DBC, which is commodities, and then UUP, which is the dollar, obviously. So we're going to take these four. We're going to use a 3 6 9 12 1 3 6 12 momentum for each of them. If they're outperforming T-bills, they go into the strategy. If they're not, you replace that allocation with the S&P 500. So it's 40% in the strongest, 30 in the second strongest, and 20, and then 10. That would fill you up in a fully defensive portfolio, right? When you do that particular fund series of calculations today, the only thing outperforming on the 1 3 6 12 momentum is gold. So you would have 40% of your portfolio in gold. Risk is on, right? Because the other three don't qualify. They're now outperforming T-bills. So what happens there? It goes into the S&P 500. So right now your defensive position is 60% long stocks and 40% long gold. So none of the defensive elements are in play here at all. Now it's actually a pretty cool system. If I was designing it, I'd probably replace the dollar with something that produced income, but that would take like days of work, and I didn't have that to put in this morning. Um, but it serves its purpose for now. So this is telling you the market's very much in a risk on environment. Real money momentum measurements are not saying it's time to jump aside. They're going to say it someday, and it will in fact be time to jump aside. But this does incredibly well from 1986 to 2025. This has matched the market within like really tiny number of basis points. 10.87 for the system, 11.17 for the S&P 500. However, worst year for the S&P 500 in there was a down 37%. Worst year for the defensive first system was a little bit less than 7%. The worst drawdown you would have experienced was 50.97% for the S&P 500, 14.81 for the defense first. When you go back, Randy, and I looked at this through now this is a very cool system, and I'll get to why I really like it here in a second. But when you look at some of the really bad things that have happened, right? The crash of 1987. Um, I might I might be the only one old enough here on the list to have been active in the market.
I was alive, but I got to admit I was playing with a Tonka truck, not the market. So
Yeah.
I can't really relate.
Okay. So market was down, of course, 29.78% during that whole little wing ding period there. This system was down 6.43. The dot com bust from 2000 to 2002, very painful period of the markets, just grinding lower constantly. Uh, the biggest drawdown in the SP 500 was about 45%, little less than 10% for this defensive first. The GFC down 50. This was down 14. COVID crash didn't go down at all. It was up. Inflation shock of 2022 was down 7 compared to the max drawdown of 23%. So you don't have any big drawdowns in this, which means we can lever the you know what out of it. So if we take this and rather than lever the commodities in the gold and the dollar, um, one of the reviews of this paper said, why don't we just take the 3X ETF and just lever stocks? So what happens now, our max drawdown goes to 33%, right? It goes up quite a bit because we've increased leverage by
Right.
3. But we get to about a 16% compounded return, and we never have a margin call. That's not bad, guys. When you look at this as something that's far less volatile to the markets than the markets, but outperforming the markets, or you could use this in a 401k to match the index without suffering through massive drawdowns. If if I could shave some years off and go back to be 50 again, and I was using this to manage a 401k, this would be smart, right? Because if I turned 50 years old in 2000, I would have missed the worst of the great financial crisis, of COVID, of the inflation shock. I would not have been subject to all of that just kind of massive drawdown activity, getting my kicked with all of that. So I thought that was just a very, very cool system.